Well, good afternoon, Apriem attendees or Apriem family. Welcome back to another one of our virtual events. First, I just want to take a moment to say thank you so much for taking the time out of your day to come and join us. Now, we have recently been kind of changing the format and trying different things as we've been doing these virtual events. And as you can see today, we're in a little bit of a different setting here. We had a lot of great feedback after last month's webinar with Harmon, where we did a more interview type style and less of the formal slides and presentations. So we're continuing forward with that today. I would ask that at the end of the presentation today, you will have access to a survey. We pop those up at the end of every single webinar that we do. We do review the surveys. They mean a lot to us, and we're continuing to take feedback. This interview style and this new location and the cameras and everything that we're doing all comes from feedback from you, the viewer. So we're trying to continue to up our game and bring better content and quality out to you. So any suggestions that you have, we ask that you provide that there. Also, it's the end of the quarter. Everyone should have received, or any of our clients should have received quarterly reports. So we would encourage you to schedule a review with your advisor. And in the survey, if you would like to schedule time for a review or a financial plan or even both, that's all. You can just check the box that's there and let us know that you would like to schedule your review meeting, and someone from our office will follow up with you. That being said, I'm going to go ahead and introduce our guest speaker. Today we have Benjamin Lau, who thank you and welcome back. So Benjamin Lau is our Chief Investment Officer. He's definitely joined us multiple times before. And then of course, today, a day like today is typically we have two really big webinars that we do each year, covering what's happening in the market and what the expectations are moving forward and everything that Ben and his team are doing. So first, Ben, thanks for being here. Second, before we start, I have to say, I read your article last week that was released. I hope all of our listeners got to see it as well, but not out of the woods yet. Released on Thursday, and great article. But it kind of reminded me, you're an avid camper, aren't you?
Yep. Just got back from Big Sur and had a great time.
Yeah. How was the trip?
It was fun. It was the weather was great, and just had a beautiful time up in the woods. So.
Very good. And so is that just you and the family, or don't you lead like a Boy Scouts or something along those lines?
Yeah, we do, but this was just a family trip. We wasn't some older friends of ours, so there's about 30 of us. But yeah, it was a fun time with a bunch of kids, a bunch of adults in the woods.
That's fantastic. Last time I tried to take my kids camping, it was a disaster. They wouldn't eat hot dogs. They wouldn't eat the hamburgers. They were starving. Next thing I know, I'm like trekking down to fast food to pick something up to bring to the campsite. I was severely disappointed. That's the extent of my camping skills. All right, so why don't we kind of hop in? But I kind of want to start with very current. What did Jerome Powell have to say for us today?
If you read my article last week, we really talk about how strong the economy has been for the first half of the year. And I think that was a big surprise for many people. And I think that's really what Powell echoed today in his sentiment with the Fed. For those of you that are watching, the Fed did raise interest rates by another 0.25 percentage point this morning. And really the reason why they felt the need to, that inflation is here, right? Inflation is still sticky. We're seeing prices come down for many goods and services that we're all using. We're certainly down from the highs you saw over the last year. Well, we're nowhere near where we want to be. And I think that's an acknowledgement by Powell and the Fed that inflation is not as low as we want to be. And in fact, if you look at some of the projections going out for the second half of the year, they think that things might get stronger. The economy might get stronger going to the second half of the year. Employment might get stronger also going to the second half of the year. And then where I think that inflation might continue to be sticky into the next 6 months.
There's a little bit off there, but I do have to say, okay, so interest rates continuing to rise. Mm-hmm. Sounds like Powell really left the door open that he can continue to raise rates, but it's yet to be seen.
It's yet to be seen. We did, all truth being told, Josh, we did get one great inflation number in the last month, right? That showed that inflation is coming down to close to 3%. But that's just only 1 month, right? And the Fed's not going to meet for about 8 weeks from now. And so there's going to be a lot of data coming out the next 8 weeks about what the Fed can act on next time.
So, okay, this is everything seems to hang on what's happening with the Fed, right? But the market's been doing really well this year, right? I mean, it's been roaring. I think it's going much better than expected. What's the deal with that? Why are we seeing that where the Fed's actively trying to slow our economy down? It seems like inflation is somewhat coming down, maybe not at the pace that we want, but it is coming down, and yet the market's still going.
That's been a great story, right, this year.
Right.
And so I think inflation was a story last year, and the Fed raising interest rates was the big story of last year. And we could argue what how much interest rates increased this year, but I think the Fed seems like they're clearly closer to being done than they were maybe a year, 18 months ago, right? And so things are toward the end of it. I think the big story this year, what continues to be the story is corporations and how profitable corporations have been in the past 6 months and will be for the next 6 months, right? That's really, frankly, what we invest for, right? We don't invest in just interest rates. We invest really in growing companies, and corporate America, by and large, they've been able to weather this downturn recently quite well. So I think that's been the reason why the market's been up so much this year.
So market's up. Corporate America is doing good. Seems like the consumer is still hanging strong. What happened to the recession?
Wow, yeah. By and large, the recession never came, right? I mean, we have numerous indicators it's pointing to recession. We talked about in the past, right? We talked about the Treasury yield curve that we've used, that we continue to use. That still is showing negative, right? That still is negative.
Yeah.
We have an indicator right here that we show on the screen here called the leading economic indicators, right? Things like, and we've talked about this in the past, things like building permits and auto loans, right? Those things that would kind of indicate future demand, new orders, new manufacturing orders, right? The LEIs here on this page here is still deeply in the red. It's still forecasting a deep recession, but we still haven't got one yet. And that's the big surprise of the year, I think.
So historically, we see all of that. Typically, the recession seems to follow. Is that still a prediction or a thought of what might be coming? Do we still think that recession's on the horizon, even though news seems to be possibly saying the alternative of that?
Well, that's why I don't think we're out of the woods yet, Josh. I mean, even though the market is up about 19% year to date so far on the S&P 500, I don't think we're out of the woods. I don't think that's the all clear sign, right? We still are seeing warning signals from this LEI chart that we have, right? That's still showing weakness. Not necessarily weakness in the consumer. We can talk about how strong the consumer has been, but really weakness in the manufacturing sector, housing, construction, right? Those sectors are really getting hit particularly hard. And those are the big reasons why this indicator is still down, right? You're seeing manufacturing sector really just not picking up. New orders are not picking up as much as you'd hope. New home construction, not quite where it needs to be. And so those are the kind of those big durable items are seeing some weakness still.
Okay. So we've got LEIs that look negative, right? But consumers are still hanging in there strong. People still have jobs, which is fantastic. On the kind of the note of jobs, is that it feels like it's been for a while now, it's been kind of that, bad news is good news and good news is bad news. Do we expect that to continue to be the story here moving forward, where, if we get a positive jobs report, all of a sudden we're seeing a market that's upset?
I think the jobs number is the job situation is another thing that's been really interesting, right, and surprising. The jobs, we have not seen any material weakness in unemployment. People are not getting laid off nearly like we saw last year. And even the people that were laid off last year seem to be able to do fine and seem to be able to find new work. So that's been a real interesting thing. Much of what I learned in school, you're talking about different theories and rules, like the Taylor rule, right? And different curves that really much want to try to predict where interest rates should be relative to unemployment rates. And all those got thrown out the window in the last 18 months. The job market is still remarkably strong. You're seeing, for the first time in the last few months, real strength in the service part of the economy, right? And as a person, I like to go out to restaurants, I like to travel. You really have seen weakness in those areas, right? You've seen airlines and restaurants not been able to hire enough people in the last few months. That's kind of turned around, and you're seeing a lot of pickup there. The question is whether or not that will continue, and I don't know, right? And I think at some point, companies are still trying to protect their profit margins. And I don't know how much more people they're going to hire, but the demand for employment seems to be really strong, especially in certain sectors of the market right now: services, travel, technology in certain cases.
Okay, so let's maybe we could back into this a little bit, you know, to help especially the viewers, you know, even understand, because you mentioned something like profit margins. Okay, but we've been spending a lot of time talking about interest rates, right? And the fact that this increasing interest rates is meant to kind of slow things down. What is kind of what's the relationship between the two? I mean, if interest rates are going up, should profit margins be coming down?
You know, I don't know if there's really a relationship there now. There has been in the past, but it really feels like in the last post-COVID world, profit margins are just a lot higher than they were maybe pre-COVID, right? And you're seeing margins up in the high teens now. And I've talked about this in the past, a couple of market updates where profit margins pretty much are near a 50-year high, and they stayed here even in the last year. And so you're seeing that companies seem like it seems like they've hired good CEOs, good managers, and really just boosted what we call operating leverage in the S&P 500. The operating leverage for companies, right? And so companies are now able to do a lot more with a lot less. And so when they're seeing that costs rise, they're able to sustain those, increased costs. They just kind of eat it, and take it right now as a little bit of sacrifice to margin.
Sure.
But with revenues being relatively flat for the last year or so, and then if revenues do increase over the next, say, 12 to 18 months, I think you really see a huge jump in operating leverage for companies because that margin is so high still.
So do you think that because we have these high margins, that helps to justify kind of these 18 times, 20 times earnings that we're seeing as far as valuations go? Or do you think that still kind of prices us relatively high in the grand scheme of things?
That's a great question, Josh. I think it really depends, right? And I think that I feel like the market is kind of split up into three different economies, right? You have the old traditional school, utility, hard, big warehouse kind of economies, big durable good producer manufacturers. And maybe have healthcare and banking, and then on one side you have technology. Where clearly technology is the big delta, right? Clearly, that's the one big sector that's been able to do a lot more, generate a substantial amount of profits with very little capital. And so I think that's been that huge rise of the technology sector, it's communications, social media sectors.
Sure.
That's been a huge reason why I think margins has been able to expand in the S&P 500 in the past couple of years or so, right? They're the ones that have the operating leverage that everyone craves,
right? So, I mean, talking about technology, I mean, technology really got hit the hardest last year, right? I think if we're looking at the NASDAQ, it was down around 33% or so. But technology's been doing great this year, right? It's roaring back. And so while the rest of the economy is not out of the woods yet, do you think that technology is out of the woods, or do they still kind of have some ways to go?
Yeah, I think I mean, if you were to ask me 6 months or 9 months ago, I think technology was in a bit of a contraction, right? You're seeing a huge decrease in spending in terms of PCs and server farms. But this whole AI revolution, this whole discussion of chatbots and AI has really been a huge driver for corporate spend. And you saw that clearly, Josh, yesterday with a couple of earnings announcements, right? And from Google and Microsoft, and they're seeing big spends. And we get a lot of questions about AI and who the winners are going to be. And I think there's a lot of companies are going to be used. I think it's be adopted in many industries, but it seems like whatever you think about AI is going to be run through the cloud, and and it's not going to be run locally. And the cloud providers are going to take a good share of the winnings right now.
Before I jump too much further forward, I do feel like we should possibly talk a little bit about some big pitfalls we saw earlier this year. One of which was SVB and everything that happened kind of in the banking sector. Seems like all that has toned down quite a bit. And while I know the increasing interest rates have slowed down quite a bit, how are banks doing as a whole?
I think banks are still struggling. Again, this is an issue of two worlds, right? And I think a lot of these smaller regional banks still have big losses from the interest rate increases we've seen over the last 18 months, right? And they continue. I think they still have, the clients are still staying around. I think they have great business models, but their balance sheet has just been substantially deteriorated because of the loss in the bond losses they've seen.
So that being the case, I mean, with all our viewers on, any kind of thoughts as far as, we never know what's going to happen, right? So how about as far as protection and safety goes for people that have money in the sidelines in cash? Any concerns or thoughts, that you would send their way?
Well, for clients that are just worried, because I think that there's a lot of concerns to be in the market, right? And I think right now, the economy is doing quite well. And we talk about here, I think, in this chart here, we talk about consumers are starting to feel a lot more positive about the economy, right? This is a chart of consumer sentiment from the University of Michigan, showing that consumers, after being quite scared towards the middle of last year, they're feeling a lot better. They're a lot more optimistic on the economy, on their prospects. But I get worried that I think maybe people are getting a little bit too optimistic, right? We've had nice gains in the stock market this year so far, and we're seeing some people move to be, I think, a little bit more optimistic than they should be. And so I think for people that are looking at some of the risk factors out there, and I think you should look for some opportunities like in fixed income, right? I think there's a lot of opportunities that we didn't see 18 months or 24 months ago in the fixed income market, where if you're a conservative investor, if you're retired, if you just need an income source, you can get 4%, 5%, 6% yields out there right now, relatively safe products that I think are really attractive to retirees. And just say, why even deal with the volatility of the stock market if you don't need to, right? And just lock in a 5 to 6% return without all that vol.
Right. I think we were looking at headlines earlier, and I was saying that interest rates are at a 22-year high at the moment. And so for any of our conservative savers that are out there, you're definitely getting rewarded for those savings now.
Exactly.
And so where it's quite a bit more expensive to borrow, right? And so if we're a young individual looking to buy a house, now's kind of a harder time to do something like that. But for those of us that have had funds, sitting on the sides in cash, earning nothing for a long time, it's really nice to be able to talk about getting rewarded for those dollars nowadays.
Let's go into this a little bit more.
Yeah.
Right? And so say we do lock in a 5.5% yield on a diversified portfolio of bonds, right?
Yeah.
So you got some 5s, you got some 6s, so you're kind of averaging out to about 5.5%. I don't know where you think inflation is going to be, but right now inflation is coming down quickly to about 3%.
Yeah,
that means you're making about a real rate of return of about 2 to 3%. That's actually pretty good historically,
right.
For returns and for modeling. So I think if inflation continues to come down, I do think that interest rates might come down, too, if we do head into recession. That means you're locking in those higher rates. You're locking in 5, 6% returns the next few years. And I think that's a pretty attractive number, right?
Yeah. Okay. So I think that's a great topic here, because this is really kind of talking about opportunities, right, of what's out there, and I might be jumping around a little bit here, jumping forward, but if we can lock in something like 5.5%, and interest rates do drop, or not interest, well, I guess interest rates as well, but if inflation does drop moving forward, would you say that's probably one of the biggest opportunities people should be looking at the moment? I mean, that's a pretty darn good rate. I know getting a dividend, from one of my stock positions paying 5% would be pretty darn good.
Right now, we do spend a lot of time talking about stocks and the economy and the stock market, but I do think there's a very interesting opportunity in bonds. And we kind of talked about this for the last 6 months, right? I think there's two things, right? Well, we just mentioned that there's higher coupons now for those people that want that higher income, right? But not everyone just needs the higher income. That's just another plus. The other thing we're seeing in bonds is that you can actually get nice appreciation in some of these bonds now too, right? If you go with longer term bonds, and that for most of our portfolios, we've been in a lot of shorter term bonds to protect against the rising interest rates. But now if interest rates start coming down, going to longer term bonds might give you a nice little boost to your portfolio, right? That's why you want what we call extend duration. Go from a duration of say 1 or half of 1 to maybe an duration of 4 or 5, 6. And that could really give you a nice little boost when interest rates. If interest rates start coming down, you can see a nice little gain on that, plus the income.
Yeah. So I know this whole topic of duration on bonds can be very complex, but for the sake of viewers who haven't studied on duration with bonds, could you give us a little bit of an example of kind of what we're talking about? If I have some bonds and I have a duration of 10 years, and interest rates were to, let's say, come down 1%, what would that do to the value of the bonds that I'm holding?
That's great. So duration is just really it's just a measure of how sensitive your bond or bond portfolio is to those changing interest rates that you're mentioning, right? And so a duration of 10 means that if interest rates were to change by 1, the portfolio would change, the value of the bond would drop by 10% or 10 times that, right? And so, for example, in the last year or so, during this last year with interest rate increases, right? The long end, a 10-year treasury, the yield rose by about 250 basis points, maybe 2.5%, right, to where it is today, and it carries a duration of about 6. Okay. So that means if you do the math, 2.5% times 6, that means that the bond market was down about 15% last year, and that's where it was. That's how we got to that math.
Pretty much what we saw.
But yeah, that's pretty much what we saw. And so now flip it on the other side. What happens if interest rates come down 1 or 2 or 3%, in the next 1 or 2 years? That means that you can actually see an increase in value in your bond portfolio,
right,
of 10 to 15%.
Okay. And this is why, if you're watching all those talking heads, on TV, this is why so many of them are talking about bonds as being a potentially good opportunity, because not only are you getting to lock in a nice fixed yield, right, on those bonds, but if interest rates were to go down moving forward, which they very likely could, but that's all to be seen. But that would also then increase the value of my bond portfolio.
Exactly. And again, Josh, we're still talking about relatively high quality bonds, but you're talking about government bonds, government agency bonds, really high quality investment grade bonds. For those people that want income, you can also start looking at lower credit bonds too. And then you get a little bit more yield. I don't think there's quite an opportunity in that section of what we call credit markets yet. That's one thing that we're continuing to look out for. We've made some moves into portfolios, into the fixed income sleeve of the portfolios this year for clients, but we continue to make those moves towards the end of the year. I think that's going to be probably a more opportunistic time to make those moves towards the next few months.
Okay, beautiful. Okay, well, so how about this? You looking forward, right?
Yeah.
We kind of talked about what's happened this year. We had SVB. I don't know if we want to talk about debt ceiling at all. And if you do, we can always get back into that. But things have actually done really well, right? We talked about a lot of things that weren't great, right? But the market's been doing well. Interest rates are high, so savers are being rewarded. How about moving forward the rest of the year? I mean, do you think that things look good or bad? What are our thoughts as far as expectations kind of go?
Well, clearly things are slowing down, right? I think things are slowing down right now in terms of the economy. You're seeing that some of the manufacturing orders that we talked about a second ago. That's why the LEI data was weak, right? People are just not buying big things right now. And I think that's a big reason why inflation is coming down. The question is, once a slowdown starts happening, how much more is that going to go? Like, you just don't know, right? And now you're starting to see that in some things that were pretty resilient so far, right? And one notable thing from this week, by the way, we're in earnings season right now, right? In the last couple of weeks, and the next couple of weeks, we're updates from CEOs and CFOs all across corporate America talking about how things are going. And one of the more notable ones I saw this week was Alaska Airlines, right? Their CEO and CFO came out and said, we're noticing a strong decline in ticket prices, ticket fares, especially since after June, since July, right? We're only about 3 weeks into it. And so that's kind of noticeable when he said that.
Yeah, less travel.
So are people pulling back on less travel? You're seeing declining attendance at theme parks across the world, right? Not just Disney, but Magic Mountain, Six Flags, everyone's seeing decline in attendance. So you're seeing some weakness there. So that's one thing that we're watching. But by and large, the biggest thing we talked about is earnings, right? And we talked about how well corporate America has been doing so far in the last 6 months and the last 12 months, managing the volatility of interest rates. How are corporations going to do for the second half of the year? And then that's a big one. Again, we're in the middle of that right now, and it seems like things are going pretty well for corporate America, right? And I would hope that many of the best managers, especially the companies that we like to buy, right, that have strong business, strong management, they've cut costs. They've done well. They've done what they needed to in the last 12 months or so to cut costs so they can really get the operating leverage really high. And so the DC revenues tick back up. They can see a nice boost in profitability and in free cash flow. And so that's really what we're waiting to see is see that turnaround, right? And that's the big question. Is this quarter, the second quarter of the year, kind of the trough in profit and profitability? Is that start to flatten out this quarter and start rising in the next few quarters?
Sure. Okay, well, so does that mean, equities or bonds or both? I mean, what's kind of what's the go-to moving forward? What are you and your team, what are you guys really kind of doing with the portfolios, given kind of expectations, what we see, what's happened, what we think is going to happen?
Yeah, we still think stocks are one of the best places to be for growth, right? We love bonds. We think it's a great opportunity for bonds. An opportunity we haven't seen in honestly in the past few years, right? Either with zero interest rates, even before COVID. But stocks are still the best place, I think, for investors to invest in America, to look for that next opportunity. And you're really seeing that this year, right? With the boom in technology stocks, with the boom in some of these AI companies. This is really, if you want to invest in innovation, you got to really invest in companies. And I think looking for companies that are going to have just really great business models, a really great competitive advantage, a great competitive advantage versus their peers, and using that to make money, and
Yeah.
that's funny as it sounds. We do want to see companies with strong growth, and really strong growth in terms of top line revenue and free cash flow.
I mean, are there any kinds of items or things you think are important to watch out for over this next year?
Well, I mean, we keep on talking about how strong the consumer has been, right?
Sure.
And they've been strong, and we can't really overly emphasize how big of a part the American consumer is to the global economy and to the American economy. And it seems right now, any given year, the U.S. consumer is about 65 to 70% of the U.S. economy. Monitoring their health is key. You've already mentioned it, Josh. With unemployment, making sure that's obviously the big statistic, right? Making sure that you don't see a huge amount of layoffs or people that can't find jobs. But luckily that isn't happening right now. Luckily, because the American consumer is doing quite well in terms of not just having a job, but having increasing wages too. And Powell actually acknowledged that today. For the first time in a while, wage growth is actually stronger than price growth or inflation, right? Consumers are seeing more gains in their paychecks than they are seeing, at the grocery store. So that's a good thing. Watching that constraint is really key. The consumer has built up a tremendous amount of savings over the past couple of years due to COVID, but they've been eating through that savings last year, right, with higher prices, and how much of an impact that's going to have on them. We are noticing a little bit of weakness, small signs of weakness. It seems like consumers are falling behind a little bit on their car payments. They're falling behind a little bit on their credit card payments. Not really in other terms of credit, but those two areas are a little bit noticeable. So that's one thing we're watching. And the thing is that the less travel thing too, that was really noticeable. If airfares are coming down quite a bit, our America is going to maybe stay at home this Christmas and not travel as much. So we're kind of looking for signs into the American consumer.
Okay.
So how strong they are.
Okay. One other kind of topic I would like to talk about a little bit here. It's the Magnificent Seven. And so I think, pre-COVID, it was all about FANG, right? And now I think that a lot of it's about the Magnificent Seven that's out there. You want to comment a little bit on that and kind of tell our viewers what that's all about?
Well, I think we all know these household names, right? The Magnificent. I think Jim Cramer penned this term on CNBC, right? These are the real 7 technology stocks that have really been leading the way since about October of last year, really since the whole AI talk happened this year. The Magnificent Seven, we all know them. It's been tremendous, right? And it's hard to imagine. Let me just put this in numbers for you, Josh. Okay, Apple started at the start of the year was about a $2 trillion company, and is now recently a $3 trillion company. Again, about $1 trillion in market cap this year. Again, like an Nvidia, or like an Netflix, right?
Like a whole,
over the year, $1 trillion again of $1 trillion market cap is a tremendous amount.
Yeah,
in less than a year, and so that's how much these names have moved from a dollar standpoint.
So, I mean, should I just be putting my money in those? I mean, is that when just ride that storm?
Yeah, I mean, it's been a growth place. It's been the best place to be, right?
Sure.
And so, and I think a lot of that was just driven by this AI stuff, right? Where they're so leveraged to, especially in Microsoft and Nvidia. They've been the big leaders there, and they both have their reasons for growth. And you are seeing these companies are great companies. I don't want to say that they're not great companies.
Absolutely, yeah.
They're starting to see that proper growth,
right.
But they're starting to get really expensive here. And so, if you look at these top 7 or 10 companies that really dominate the market. You can look at outside of that. And so here's a chart. This is a really just a general evaluation of the market. Right? You're talking about, say, the PE. So right now, the PE for the whole market is sitting about 19 times right here on this 19.1 time, which is, it's not cheap by any means, but it's not super expensive. It's kind of on the slightly expensive, slightly warm side. But let's break that down a little bit. So let's slice off the top 10%, the top 10 names, excuse me. That drops. The top 10 stocks have a PE of about 29 times. That is really expensive, right? Those top names, they're trading at a really expensive multiple. When you slice those names off and just leave the rest of the 490 names, the rest of the 409 names have a much more reasonable valuation within historical norms, close to about 17 times earnings. So that really shows you how expensive those top names are. They're great. I don't want to discount them, but they're priced to perfection.
So we talked about the Magnificent Seven. Let's see, we've talked about bonds. And we've kind of talked about some of the pitfalls or things that we would want to kind of watch out for and be careful about moving forward here in the future. So any kind of finishing thoughts or things that things that you would want to leave behind before we sign off?
Yeah, no, I'm still pretty optimistic about the U.S. economy. I think they're definitely leading the way in terms of the global economy. You're seeing it's amazing that the U.S. has some of the highest growth rates and lowest inflations among major economies. I think that's a great mix. I think we really managed the past few years quite well. But that's why I think stocks are some of the best places to be. But just pay attention to valuation. Right? Look at those other names besides those top 10 names. I think there's a lot of great values in certain pockets of the market. There's also a lot of great value in certain pockets of fixed income. So I think it's a pretty good time for investors right now to move money out of cash and into bonds or stocks, depending on your risk category.
All right, beautiful. I did have actually one last thing I wanted to run by you before we let everybody break. About this time last year, markets weren't necessarily doing as well. And one of the biggest questions that kept coming up over and over and over was, how long do we expect it to take to recover from the losses that had occurred? Yeah. Have we recovered from losses? How far away are we? And how does that kind of track with what, kind of the general or average expectations are to recover?
Yeah, you asked me about this, and I thought about it. I was doing some research on this. I kind of think about things in two different categories, right? And last year, we're from high to low, we're down about 25%. That seems like that is about a typical decline in markets, right? Especially when you factor in we didn't have a recession, at least not yet.
Right.
25% decline is pretty normal for a non-recessionary bear market. We do have a recession, if we do have a crisis, right? Like the global financial crisis a few years back, it could be a lot more, 25, 40, 45% declines. But during a normal non-recession decline, the market generally snaps back pretty quickly. You're looking within 6 months to a year and a half to recoup those 20, 25% losses. With this recession that does happen, it can take a little bit longer, but it's relatively quick. Is the surprising thing.
Yeah, so, and we're pretty much we're getting very close.
We're getting very close.
Very close.
Yeah. As about an hour ago, we're maybe about a 5% off the all-time highs. So we're pretty there. We've gained almost everything back.
Yeah, that's fantastic. It's fantastic news. It says a lot about our economy and where we're going. And ideally things just continue to move forward as they have been. So do you want to maybe pull the disclosure slide up and I'll kind of finish this out here?
There it is.
Oh, okay, perfect. All right. So as I kind of close this out here, if you have any remaining questions, you're welcome to enter them in as I do closing remarks. So first off, thank you again for everybody for joining us. We will have this video saved, recorded. We'll edit it down. We'll get it posted on the website. Typically takes about a week or so before it ends up on our website. So if anybody wants to come back, watch it again, send it to somebody else, it'll be there and available. Again, we would like to encourage you to please complete the survey. Let us know what we can do better, and let us know if you'd like to schedule a review with your financial advisor. On that, then we hope everybody has a wonderful weekend. We thank you for joining us.
Thanks, Josh. Thanks, everyone.